Welcome to the Deep Dive. We're digging into New Holdings' first quarter 2025 results today.
That's right.
Our mission, as always, is to unpack those key numbers, figure out what management's saying between the lines, and what it all really means for you.
Sounds good. And yeah, this quarter definitely showed some strong momentum carrying over into 2025. Let's maybe hit the big numbers first.
Yeah, let's do the headlines. What really jumped out at you?
Well, the scale is it's huge. It keeps growing. Total customers are now at 119 million.
119 million. Wow.
And if you break that down, it's like 105 million in Brazil, 11 million over in Mexico, and they just crossed 3 million in Colombia.
Okay, so massive reach. But are these people actually, using the service or just signups?
Oh, they're active. That's the impressive part. Monthly active customers are getting really close to 100 million now.
Almost 100 million active.
Yeah, and the activity ratio is holding steady. Above 83%. So people are sticking around, using the app. That's pretty key.
Right. That engagement is crucial. Okay, so lots of active users. How's that feeding into the core banking stuff, like credit?
Credit portfolio saw really solid growth. It hit $24.1 billion in Q1.
Okay.
That's up 8% just from Q4 and 40% compared to last year if you strip out currency effects, the FX neutral number.
40% year-on-year growth on that kind of base. That's significant. And the flow of new loans, originations?
Yeah, originations hit a new record too.
Yeah.
$20.2 billion Brazilian raise originated in the quarter.
Okay.
That's a jump of 64% year over year. And most of that, the bulk of it, was unsecured loans, personal loans, credit cards, that kind of thing. They hit $17.3 billion raise.
So credit's accelerating, originations are booming. How are they funding all this? Deposits holding up?
Deposits are also growing really well. Total deposits hit $31.6 billion.
$31.6 billion.
Yep, up 48% year over year, FX neutral. Sequentially, it was about 1% growth, FX neutral, so still building that funding base.
Okay, and with all that activity, strong lending, strong deposits, that must be flowing through to the income statement.
Oh, absolutely. Net interest income, NII, basically profit from lending versus paying for deposits, hit a new all-time high, $1.8 billion.
$1.8 billion NII.
Yeah, that's up 34% year over year, FX neutral, and 5% just from the last quarter. So strong core earnings power.
And on the efficiency side, that digital model they always talk about, is it delivering?
Hugely.
Yeah.
Their efficiency ratio, basically costs as a percentage of revenue, improved quite a bit. It came in at 24.7%.
Wow.
And even if you back out a one-off tax credit they got, it would have been 26.6%. That's, really best in class efficiency. Yeah. Shows that operating leverage kicking in hard.
And that leverage, that efficiency hits the bottom line.
Definitely. Net income reached $557 million for the quarter.
$557 million.
Yeah, a jump of 74% year over year, FX neutral.
74% growth. That's a massive number. How does that look on a return on equity basis, ROE?
ROE came in strong. Annualized was 27% this quarter.
Yeah, 27%.
And what's really notable there is they did that while holding something like over $4 billion in excess capital. So the underlying profitability is actually even higher. Puts them right up there with the most profitable banks in the region.
Okay, those are definitely some impressive headlines. Strong growth, improving profitability, huge scale. But, numbers only tell part of the story. Let's get into the context. What was management really emphasizing on the call? What were the analysts asking about?
Yeah, good point. One of the big themes management kept hitting on was just how much opportunity they still see ahead, even in Brazil. Right? Their most mature market.
Right. You hear Brazil and think mature, but...
Exactly. They serve something like 60% of the adult population there already. And a really high percentage of their customers say New Holdings is their primary bank.
60% of adults in Brazil. That's just staggering reach. But the numbers show an interesting dynamic, don't they?
They do. Because despite having, 60% of the people, their share of the profit pool in Brazilian banking, the gross profit market share, is still only around 5%.
5% profit share versus 60% customer share. That's a big gap.
That's the opportunity right there. That's what they're laser focused on. They have the customer relationship, the trust. Now it's about deepening it.
So basically, selling more products to the existing base, getting them to use the platform more intensely.
Precisely. They feel like they're still, in the early innings of really monetizing that massive base through more usage, more cross-selling, and they're enabling that by constantly improving their tech. They mentioned new AI capabilities in their credit models, for example.
The AI angle, helping them lend more, but responsibly.
That's the idea. using data and AI to understand risk better so they can responsibly expand credit access to more people within that huge customer base they already have.
Okay, makes sense for Brazil. What about outside Brazil? Where's the next big push?
Mexico. That was clearly spotlighted as the next major growth engine.
Latin America's second biggest market, right?
Right, exactly. Second largest banking market, but also, crucially, one of the most underpenetrated, especially for digital banking and financial inclusion. And they've got real momentum building there.
How's the growth looking in Mexico?
Pretty explosive, actually. Customer base grew 70% in the last year. Deposits more than doubled. FX neutral. Things are moving fast.
And they hit a major milestone there just recently, didn't they?
Yes, huge news. They got their banking license in Mexico just a few weeks ago. That's a potential game changer.
How so? What does the license unlock?
Well, they expect it to really accelerate growth. It lets them offer a much wider range of products, proper checking accounts, more sophisticated lending, maybe investments down the line. It moves them beyond just the initial simpler offerings.
Got it. And this whole growth story, Brazil, Mexico, it seems tied fundamentally to that digital operating model. How did they explain the leverage playing out?
Yeah, it's really kind of the secret sauce, isn't it? They talked a lot about ARPAC, average revenue per active customer.
Right, how much money they make per customer.
Exactly. And the key is that number grows significantly over time as customers mature, use more products. It starts low, maybe around $5 when someone first joins.
Okay.
But after, say, 7 or 8 years, that can grow to over $25. And they think there's potential to get it even higher, maybe towards the $40 plus that traditional banks see as they roll out more complex stuff.
So ARPAC goes up steadily over time. What about the cost side of serving that customer?
That's the magic. The cost to serve stays incredibly low because of the digital model. It's less than $1 per customer per month.
Still below $1.
Still below $1. And thanks to tech and scale, that cost has actually dropped by over 80% in the last few years.
Wow.
So you have a revenue per customer climbing steadily and cost per customer staying super low, even falling, that widening gap. That's the engine driving the profit growth and the efficiency gains we saw.
It sounds like they're willing to make investments now, even if it sort of dings the short-term results slightly.
Yeah, they definitely reiterated that commitment to long-term value. They're not optimizing for just this quarter's earnings. A perfect example is the big investments they're making to build local deposit franchises in Mexico and Colombia.
Right. Why is building up deposits in those new markets so critical, even if it costs more initially than, say, wholesale funding?
They see it as absolutely foundational. It's the same playbook they ran successfully in Brazil. A strong local deposit base gives you stable, reliable funding for lending growth down the road.
Okay, stable funding. Makes sense.
But it's more than that. It also generates tons of valuable data about how customers are saving spending. That data feeds right back into their AI credit models. It helps them underwrite better, lend more responsibly as they scale up credit in those markets. It's critical for sustainable growth.
Speaking of credit and risk, how did asset quality look this quarter? Always a key focus for a fast-growing lender.
Yeah, they gave a pretty detailed picture. Early stage delinquencies, that's loans 15 to 90 days past, they ticked up seasonally, rose by 60 basis points to 4.7%.
Okay, a seasonal rise. Was that expected?
Pretty much. And actually, they pointed out it was slightly less than the typical seasonal increase they usually see in Q1. So maybe a bit better than expected on that front.
And what about the more serious delinquencies, the later stage ones?
The 90-plus day NPLs, non-performing loans, those actually declined, dropped 50 basis points to 6.5%.
It's declined. That seems counterintuitive if early stage went up.
Well, it outperformed the historical trends for Q1. They said it reflects the lower levels of early stage delinquency they saw in previous quarters finally flowing through. So the trend on the really problematic loans is actually looking positive.
Okay. So how did all that affect their loan loss provisions, the money they set aside?
The allowance for credit losses rose to $973.5 million. That increase was mostly driven by two things. Just the overall growth in the loan book and that seasonal Q1 rise in the early stage delinquencies we just talked about.
Got it. And putting it all together, the NII growth, the provisions, what did that do to their risk-adjusted margins?
Right, the risk-adjusted INIM. That takes into account the expected credit losses. It did decline this quarter by 130 basis points down to 8.2%.
130 basis points is a decent drop. What drove that?
Management broke it down. They said roughly 3/4 of that decline was purely due to those seasonal effects on the credit loss allowance, basically, booking higher provisions because of that Q1 uptick in early NPLs.
Okay, so mostly seasonal noise.
Mostly seasonal. The other quarter, the remaining bit of the decline, they linked to that short-term pressure on the regular IM coming from the strategic investments in building up deposits in Mexico and Colombia. Higher funding costs there temporarily.
So a temporary dip driven mainly by seasonality and those strategic investments. That seems manageable.
That's how they framed it. They also touched on coverage ratios, how much allowance they have versus loans. The ratio over the total loan balance went up a bit, which they said reflects the mix shifting towards, interest-earning cards and unsecured loans, which carry a bit more risk. The ratio over the 90-plus NPLs highlights how they front-load provisions under the accounting rules. They see that as being prudent.
Okay, let's shift to the Q&A. What were analysts digging into after the main presentation? Anything on Brazil's margins specifically?
Yeah, that came up. They were asked about the stability of Brazil's standalone NI, which was strong at 21.8%.
21.8%, still very high.
Very high. And largely stable. They put that resilience down mainly to increasing their loan-to-deposit ratio, the LDR, in Brazil.
Right.
Basically lending out more of the deposits they have there.
So sweating the assets more effectively.
Exactly. And that LDR increase is helping offset some headwinds like higher interest rates in Brazil, the Selic rate, and also some mix shifts like them maybe pulling back a little on riskier PIX financing. They actually think further LDR increases in Brazil could drive NIM up there in the medium term.
Interesting. Was there anything else impacting originations? I think I saw a note about FGTS loans.
Yeah. Good catch. There was a temporary glitch, an operational disruption with the API connection for FGTS loans. Those are the loans backed by the government severance fund in Brazil.
Okay. When did that happen?
Late February, early March. Management reckoned it probably caused about a 10% hit to their FGTS loan originations just for Q1. So a bit of a drag there, but temporary.
Did anyone push them on expansion beyond LatAm? Is that even on the radar anymore?
He got asked, yeah. But management was pretty clear.
Yeah.
The focus right now is absolutely laser sharp on Brazil, Mexico, and Colombia.
Just too much opportunity there to get distracted.
That was the message. The opportunities in those three markets are just enormous. They did say they're still allocating a small amount of resource to thinking about future internationalization because they think the digital banking model works globally, but near term. It's all about execution in those core LatAm markets.
Okay. Going back to that risk-adjusted NIM decline, did they give any more color on where that's heading?
They basically reiterated the Q1 story.
Right.
Mostly seasonal impact, about 3/4, with the rest being those Mexico-Colombia investments. Looking ahead for Brazil, they expect risk-adjusted margins to be largely stable, maybe even trend up a bit over time.
Driven by
Those LDR increases we talked about, and just general operating leverage.
Mm-hmm.
For Mexico and Colombia, margins will probably be tighter in the near term because they're investing so heavily. But the goal is for the overall profitability, think ROA, ROE, to eventually converge towards Brazil's levels, even if the NIM structure is different.
Right. Different paths to similar profitability. What about the big push into secured lending? Payroll loans, FGTS, that seemed like a big theme.
Huge theme. They see massive potential there, especially public payroll loans, where they're busy signing agreements and getting connected. And also FGTS and private payroll, where they think their digital model and low costs give them a real advantage over traditional players.
How big are they in FGTS already?
Pretty significant. They estimated they accounted for maybe 20-25% of all FGTS originations in Brazil last year, possibly even 30% in early 2025 before that API issue. For private payroll, they're testing collateral types and plan to lean in hard.
Is there a risk that pushing secured loans cannibalizes their existing unsecured business, people switching over?
They don't seem too worried about that in the short term. Their view is that the whole market for secured lending is growing so fast, especially as they make it more accessible digitally, that it will be mostly incremental growth. The expanding pie outweighs any potential switching, at least for now.
Okay. There was one slightly odd question, I thought, about customers who are active for revenue but don't transact. Something like 9 million cardholders.
Yeah, about 22% of the card base. Management explained that's largely down to their conservative starting credit limits.
So they give small limits initially.
Especially for customers with thin credit files.
Yeah.
The idea is people start transacting more once their limits get increased based on good usage and payment behavior over time. So it's more a function of their prudent onboarding process than a lack of engagement, apparently.
Makes sense. And finally, that debt renegotiation program, ECOMU, Any impact?
No impact on Q1 results. They actually expect a small positive impact in Q2 from higher recoveries on those restructured debts.
So it's about helping customers get back on track.
Yeah, giving them a fresh start, potentially reactivating credit down the line. But they stressed it's carefully designed to avoid, moral hazard people thinking they can just default and get a deal. And they specifically said it wasn't related to PIC's financing issues.
Okay. One last thing, funding costs. Did that come up much, especially with rates potentially staying higher for longer and those international investments?
It did. For Brazil, they said they aren't planning to be super aggressive in pushing down deposit costs. They want to stay competitive to keep attracting those retail deposits, which are core to the strategy.
Okay.
They did acknowledge that as the loan book shifts to longer duration secured loans, they'll probably need longer duration funding too, which could nudge costs up slightly. But they feel they have plenty of retail deposits and medium long-term funding already in place. The real focus in Brazil is leveraging those deposits more, increasing the LDR, which they see as a key tailwind for NIM.
And from Mexico and Colombia.
There, it's more about optimizing the funding cost and getting the LDRs up over time.
Yeah.
That's the path to converging towards Brazil's overall profitability, the ROE picture.
All right, we've covered a lot. The numbers, the strategy across markets, risks, Q&A. Let's pivot slightly. Time for our This Is Not Financial Advice segment.
Okay, disclaimer firmly in place. These are just thought experiments based on the call. Absolutely not investment recommendations. Purely for discussion.
Got it. Idea number 1. Looks like a convergence play.
Yeah, basically betting on the story playing out across LatAm. You could, hypothetically, go long into the holdings, buy the stock. And maybe pair that with a short position in a basket of traditional, slower-moving Latin American banks.
The thesis being?
The thesis is that NU's digital edge, the operating leverage, its ability to grab profitable share, especially as Mexico and Colombia ramp up, will just drive superior ROE growth compared to the old guard stuck with legacy costs and slower digital adoption. You're betting that efficiency gap widens.
Okay, betting on the digital disruptor versus the incumbents makes sense as a theme. What's idea 2?
Idea 2 is a bit more niche. It focuses specifically on that secured lending push in Brazil.
Right, the payroll and the FGTS stuff.
Exactly. So you could go long NU again, but this time specifically targeting the upside from them cracking that secured market.
Yeah.
And maybe use short specific Brazilian loan brokers or smaller banks that have traditionally owned those segments, often offline.
So betting NU's digital model takes significant share there.
Yeah, the hypothesis is that their low-cost digital approach and huge customer base lets them rapidly capture market share in secured lending. This should boost their risk-adjusted margins in Brazil specifically, maybe faster than the market realizes if they're just looking at the consolidated numbers weighed down by the new market investments. It's a bet on that specific execution point being underestimated.
Interesting, a more targeted play. Okay, so summing it all up, you've got a company juggling impressive profitability and scale in its core market, Brazil, while pouring money into these huge growth opportunities next door in Mexico and Colombia.
Right, balancing act.
The digital model clearly works, delivering that operating leverage, and they're actively managing credit while also pushing into these potentially safer, high-growth, secured lending areas.
Yeah, that's a pretty good summary. They've got the customers. Now it's about execution, monetization, and making that playbook work consistently across different markets.
And just to reiterate one more time, this deep dive has been a summary of the earnings call and our interpretation. It is definitely not financial advice. Do your own research.
Right. Absolutely. And maybe here's a final thought to leave you with, circling back to that core Brazil story. They have 60% of the adult population as customers, right?
Right.
But only 5% of the banking profit pool.
That gap again.
That massive gap. So the question to ponder is, how quickly can they realistically close that? What specific products, what strategies do you think will be the absolute key levers to turn that massive customer scale into a much bigger slice of the profit pie in Brazil over the next, say, 3 to 5 years? Answering that has some potentially huge implications.